Thank you for joining us today. Happy to have you on this webinar. It involves whole life insurance pros and cons. I've got our IBC practitioner, whole life expert, Barry Brooksby. Barry, welcome. Appreciate you being here.
Thank you, Steve. Good to be here.
So we've got a great topic for you guys to consider today. What we wanted to do is just put together some pros and cons, on whole life insurance in general. So our goal today is to help you understand the top 12 advantages of whole life insurance. We also want you to understand some of the downsides of whole life just to help determine that whether it's right for you at this point in time. We also want you to understand the difference between mutual and stock whole life companies. And this goes into our top 12 advantages, and we're going to unveil the difference, talk about that, and then highlight a few of our criteria for choosing our top whole life companies. And when you get into more detailed discussions, you may want to consider how we find our top companies, because it's really important and not everyone goes about this process so methodically as we do for our clients. Let's jump right in.
Our top 12 whole life insurance advantages: number one, ownership. You see two, permanent. And this is really important because a lot of people out there are getting term insurance that will expire. Steve, I don't know if you knew this or not, but less than 2% of term insurance ever pays a death benefit. Now, I have term insurance and I'm a life insurance advisor, but I also have permanent insurance. I have the term insurance because I want to protect my human life value while I have children at home and some other things. But what's great about the permanent benefit and advantage is this death benefit, it never goes away.
Awesome, Barry. Actually, from an estate planning perspective, the permanent protection is awesome because you're right. The term temporary protection eventually will expire. And of course, the insurance costs just keep going up, and up. So for folks to have permanent protection is huge, and that's key.
And because we don't know when we're going to pass away, most of us will outlive our term insurance. And from your perspective of the estate planning, if you're wanting to leave a legacy, or if you have tax that will be due upon death, and you're planning on covering that with term insurance and you outlive your term, there's going to be a heavy tax consequence. It's going to fall on your family. So the permanent protection does allow for much more advantageous estate planning.
And actually, so you look at it as maybe a reverse, right? Permanent protection actually gets less expensive as you get older. The reverse is true on term. I also love the fact that you mentioned human life value. Folks, if you're listening, your human life has value. We want you to recognize it. And we believe whole life is the best way to capture it long term.
Wonderful. Forced savings, tax favored, number 4. This is probably my favorite. In that if the policy is structured correctly, you do have tax favored benefits on the death benefit and also on the cash value. In most cases, even tax free. We want to make sure, though, in order to get that tax free benefit, that certain parameters are met. But tax favored is a huge advantage in order to, one, either use money in retirement tax free, or two, as we were saying earlier, the death benefit can potentially pass tax-free to your heirs and beneficiaries.
Yep, and that's a topic in and of itself. For you guys listening, there's a lot of information on the website about tax benefits of whole life insurance, as well as some of the other things we touched on. Human life value, we have actually an article on that you can dive in a little more deeply on the website.
And with creditor protection, in most states, cash value and death benefit are protected from creditors, lawsuits, even bankruptcy. So you want to check your particular state. But imagine having your cash or money in a vault. It's protected from those creditor situations. In a whole life policy, you do have a guaranteed death benefit, guaranteed fixed premiums that will never increase, and guaranteed cash value. So as we compare those 3 guarantees to term insurance or other types of insurance like indexed universal life, those guarantees aren't necessarily there. Whole life insurance is a product that's been around for over 200 years. It's time tested, well established, and the guarantees now give us more predictability in our portfolio, and we can plan for the future knowing what's going to happen because we have a whole life policy in place.
Right, Barry, I'm glad you mentioned that. For anybody listening, if you're getting the heavy sale on the indexed product of some kind, definitely reach out and compare it. Barry's very adept at just doing calculations and showing people based on the guaranteed portion of the whole life illustrations, the difference long term and the predictability of whole life, which is a huge part of the advantage when you're looking and comparing to other products.
Number 9 is dividends. We work specifically with mutual insurance companies. These insurance companies pay dividends. As a mutual policy holder, those dividends come back to us, typically reinvested back into our cash value. So there's more compound growth on the cash value. Whereas a stock company, those dividends are going to the investors, not necessarily the policy holders.
True compounding.
Yeah. And a little more aggressive compounding because of the reinvestment. And with the dividend, the companies we use have paid dividends for over 150 years. It's not like we have to worry whether they're going to pay that or not. The dividend is not guaranteed, but it has been paid for so long, we believe it will continue to be paid. We're just not exactly sure what the dividend will be, but it is a great benefit to have inside of your whole life policy. Living benefits. Well, what do we mean by that? We're talking about ways to use your death benefit while you're alive. Imagine that. A lot of people think, well, if I have a whole life insurance policy, the only one that's going to benefit are my heirs or beneficiaries when I pass away. And that isn't true. There are free riders and also riders that you can purchase that allow you to use your own death benefit while you're alive. We call those living benefits. If that's a new concept to you, hopefully your ears are perking up to think, man, maybe whole life insurance is better than I thought. And I teach my clients, Steve, another concept about spending and enjoying their own death benefit while they're alive. It's a permission slip conversation I have with clients. We won't get into it today, but when I have one-on-one calls with clients, we have that conversation about being able to spend and enjoy your own death benefit while you're alive.
Barry, this includes things like long-term care planning, and also really is a big part of high cash value, what we like to call high cash value life insurance.
That's correct. Use your cash value while you're alive, or as you mentioned, if there's a long-term care issue, chronic illness, terminal illness, critical illness, those types of things can allow you to access death benefit while you're still alive. As we talked about living benefits, one of the benefits that you can purchase is what's called a waiver of premium rider. It simply means that if you were disabled and you couldn't perform 2 of the 6 tasks, daily living, yes, that's right, that the life insurance company will make your minimum premium payment for you on your whole life policy so that you don't lapse your policy. You still have your death benefit.
I can touch on control real quick. Control is really about creating predictability. As a planner, that's huge. You have more predictability with whole life than by far than any other, well, really, in my opinion, than any other financial product out there.
I draw out for my clients on a whiteboard problems with the stock market, because a lot of people are investing in 401ks and IRAs, qualified plans, stocks, mutual funds, etc. And what they're dealing with in those types of investments are volatility, fees, and then taxes, because it's a lot of tax deferral where they'll pay tax on their entire portfolio when they do take money out. But then I draw this little phrase up above that, and the phrase is no control. Because we can't control as investors what the market's going to do. You're either in or out of a stock, or you're in or out of a mutual fund. You're not controlling what that particular investment will do. On the flip side, when I'm drawing on my whiteboard, the other side of the whiteboard, and we're talking about all of these benefits of whole life insurance, the phrase I use is control. Because when you have guarantees in your portfolio, guarantees in your financial plan, you're in control now of your future. That's huge. That could potentially be number 1 in all of these advantages.
No matter what you think about other products in terms of other kinds of life insurance, the other products out there shift the risk away from the company back to the consumer. As a consumer, you're thinking about the different aspects of whole life, and we're going to get into some of the drawbacks or the things to consider. But they're usually related to the fact that the risk when you purchase a different kind of product, like a term policy or an indexed universal life, the risk just went back to you as the consumer for the most part because you're bearing all of the uncertainties.
Yeah, and we really want insurance to take care of our risk, to limit our risk, to remove our risk. Whole life
Yep. And
insurance is the only product out there that will do that from a life insurance perspective, that allows us to truly mitigate our risk, remove it, shift it to an insurance company.
right. And I suppose people might ask, well, why do you think term shifts the risk? And it does because there's a risk that death benefit will never be used. And you're also bearing the risk of increasing costs down the road.
That's correct.
So Barry, a few downsides, we put these in here because we always want whatever product we're talking to a client about, we want it to be right for that particular person's circumstances. And so obviously when you're purchasing whole life, there's things to know and consider whether whole life is right at that particular time for you. And also the amount of and the design of the policy and all these things. So I'll speak to that. And so obviously whole life's more expensive than term, but term gets more expensive with age. Whole life, potentially the premiums can be paid within a period of time. That's getting less expensive as you age versus term, which just continues to get more expensive.
That's right. And if you had a whole life policy compared to a term, the issue we run into is no one knows when they're going to pass away. And the percentage that I shared earlier is that less than 98% of term insurance pays a death benefit. Whereas if you do have a whole life policy, although you're paying a higher premium, you are guaranteed that death benefit will be paid to your beneficiaries. It's a guarantee. I mean, what a wonderful thing to have in your financial portfolio. In essence, it feels like you're paying more for it, but over time, it is a less expensive policy than insuring your whole life with term insurance.
Mary, have you ever had someone say, but I heard somebody, I won't name any names, say that I need to buy term and invest the difference?
Always hearing that every week. And the issue with buy term and invest the difference, number one, is the term insurance will expire at some point. When that happens, Steve, there is now pressure on that person's assets and portfolio to actually perform better. Because when they pass away, that portfolio of investments really is going to become their life insurance. They might pass away prematurely, or they might not want to spend that money because they have a fear of running out of money. Well, when they die, the money they had is going to go to their family, more than likely. And what does the family do? They spend the money. Well,
Yeah.
I say to clients, you should spend and enjoy all the money that you worked hard to earn and invest and save. And if you have a permanent whole life death benefit, you can feel confident in spending that money because upon your passing, that death benefit will come in and replace the money that you spent. So there's this mentality of a permission slip, being able to spend and enjoy more of your money. But the second issue with buy term and invest the difference is, number one, do people really invest the difference? And if they do, what are those investments doing? The so-called financial gurus out there tell people they're going to earn 12% a year in mutual funds. Well, historically, that doesn't happen. Even the S&P 500, okay, the best of the best index out there, our 20-year history look back, it's only averaged 5.6%. So if you're hearing an advisor or one of these so-called financial gurus tell you you're going to earn 12% in mutual funds, you better not take it seriously, because you'll be very disappointed at the end of the investment portfolio when you don't have the amount of money that you thought, because you've got to factor in volatility, fees, and then paying taxes on any growth.
Yeah, and we've all seen that play out. I mean, I think most people that are at least over 40 have noticed that maybe the financial projections didn't quite live up to reality on some of those things. But hey, Barry, this kind of goes into the next sort of thing, agent commissions and fees and expenses. And I think we should just touch on the fact that these considerations certainly aren't happening in a vacuum for whole life. They should also be concerns for any kind of financial account or anything touted, say, by the sort of financial gurus. You always want to look at what the fees and expenses on all these accounts are.
Yeah, not just whole life exclusively. And sure, there is a larger agent commission paid on a whole life policy in the first year. But when we run that side by side to a traditional market-based investment, the fees in a whole life policy over someone's lifetime actually are about 10 times less than they would pay in their market-based accounts or managed portfolio. It's pretty surprising.
It is. And I know you show those numbers. You can actually do the side-by-side calculation on that.
Yeah. And what's interesting is an insurance advisor will continue to earn a small percentage for servicing the policy every year thereafter, but not that large commission again. It's a small percentage, but here's the difference. That small percentage is only earned on the premium amount put in that year. Whereas take a money manager, a financial planner, they're earning that fee on someone's entire portfolio balance. And that's where you see the difference.
Well, and I'll just jump in and mention it. And also for high cash value policies, which, we do a fair number, really the commissions are different too, correct? Maybe we want to highlight that.
They are. Today we're talking about traditional whole life insurance, but what you're referring to is a high cash value overfunded policy. We call it infinite banking. The commissions on those plans are reduced dramatically, 50, 60, 75% in some cases, but the client actually gets a better policy because it's a very aggressive cash value policy.
Right. Worth touching on. Death benefit. I always think of this like a piece of real estate. You have a home with equity in it and you die, that entire home then goes to the beneficiaries of your estate. Sometimes people get confused because there's cash value and there's also a death benefit. The cash value, in a sense, funds the death benefit. That's the way I look at it. But people think they're losing their cash value. They're not. It's actually the death benefit in a manner of speaking, at least my way of looking at it. But what's your thought on that?
In a traditional whole life policy, it does appear at face value that you lose cash value, but that isn't the case. The death benefit in a traditional whole life policy usually isn't growing very much, or it's growing very little. And so when you pass away, it is the death benefit that will go to heirs. So let's just use an example. Let's say there's $1 million death benefit that you paid for, and in 30 years, it's still $1 million, but there's $300,000 of cash value. You would think that, hey, I want my family to get 1.3 million. In traditional whole life, it doesn't work that way. But if you pulled out the 300K and you passed away the next year, that 300,000 would be reduced from the million, so your family would get 700,000. So $1 million would have been paid out. In an infinite banking policy, the high cash value policy we were talking about just a minute ago, the death benefit is growing quite dramatically. And in most cases, the death benefit is larger than the original whole life death benefit purchased plus the cash value. So I can show in that type of plan, the family, the beneficiaries, the heirs would actually get more.
Interesting. And then, of course, we have our MEC limits. We've got articles on the MEC, and we talk a little bit about overfunding. So there are limits, obviously, to whole life in terms of how much you can put into the policy. Is there anything you want to share on this one, Barry?
Speaking again of traditional whole life, the reason we have the line here that says avoid overfunding, we're not telling you not to overfund. We're saying, though, in a traditional whole life policy, if you overfund or try to send the insurance company extra money, you could potentially MEC the policy. That stands for Modified Endowment Contract. It's an IRS guideline that says based on your death benefit amount, there's only so much cash value that you can put into a policy. On the flip side, if we're talking about a true infinite banking policy that is an overfunded policy, I make those adjustments for clients so that they can overfund high amounts of cash value. We fix the MEC limits in the beginning so there's no issues. But in a traditional whole life, yeah, you've got to be really careful about this because you definitely don't want to MEC your policy and trigger some tax consequences.
We always talk about you need an experienced expert to do these designs that the majority of insurance agents out there, and probably a good handful of whole life agents out there, may not have the expertise to do a high cash strategy. And of course, that's a little outside of our webinar, but we just want you guys to be aware there's different kinds of whole life when you consider the advantages and downsides. Well, we're going to touch on this part really quick, mutual versus stock companies. We already did touch on it in the advantages when we're talking about payment of dividends and tax advantages to dividends. And really those things relate to mutual whole life insurance. Mary, do you want to break that down or add anything to this question?
I'll just simply say, if you're looking for whole life as a death benefit play, and that's your main goal, it isn't so much an issue whether you go with a mutual company or a stock company. This comes more into play if you're wanting to use your cash value. If you want dividends coming back to you to be reinvested into cash, if you want dividends coming back to you in retirement that you actually can use for income, you want to go with a mutual company.
Yeah, and the mutual company focuses more on the policy holders. It relates to receiving dividends, is what you're saying. Stock companies focus more on the shareholders. So you've got a little more of a policy holder emphasis, I suppose, with a mutual company.
Yeah, and it has been historically shown, and we even see it today. Mutual companies are more conservative on their investment portfolio, usually a little more solid in that investment portfolio, where a stock company might take some additional risk, not as conservative because they're wanting really to appease the investor on a quarterly return basis. They are a stock company. They're out there wanting to be profitable for their investors.
Great overview. All right, we wanted to include this quick snapshot of how we vet best companies. These are some of the standards that we use, and I just want to make mention of the fact that you have to be a little careful because not everyone does in the industry. Some people have just a specific company they work with. They'd be considered captive. Usually those are well rated, but again, you're not getting the choice, right? And so we always want to make the best whole life company available to you. That's our goal.
I'll just emphasize we're always doing the best thing for our clients. That's our goal.
Yep. Excellent. Well, we appreciate you joining us today. If you want to learn more, there's a way to fill out a questionnaire and to request some additional information. You can request a private discussion and even have a forum there to get specific examples on how whole life can work for you. Click the link below, and we thank you for being here, and feel free as well to check out the other resources, other webinars on various topics. We want you to get educated and understand how power of life insurance can impact your life. Just click the link below to learn more. Thanks for being here.